Most traders still use the RSI completely wrong. They see it dip below 30 and smash the buy button, or spike above 70 and hit sell, stop right there. The problem isn't RSI, it's that you're using it completely alone. And the one thing missing from your setup is what's been costing you every single time. By the end of this video, you'll understand the exact approach I use to stay consistent. Let's get straight into it. RSI is a momentum indicator. It measures how hard and how fast price has been moving recently on a scale from 0 to 100. Below 30 means selling has been intense. Above 70 means buying has been intense. That's useful, but it doesn't tell you where the selling stops. It doesn't tell you if you're at a level that actually matters. It's a timing tool with zero sense of location, so it can keep reading oversold while price keeps falling. The analogy I like is a fuel gauge. It tells you the tank is almost empty, but it doesn't tell you if you're in the middle of a desert or a mile from a gas station. Same fuel level, completely different situation. That location information, that's what support and resistance gives you. And when you combine the two, RSI suddenly start making a lot more sense. Now before you say, I already know what support and resistance is, stay with me, because most people draw it completely wrong. Support and resistance are zones, price areas where real, significant buying or selling happened before. When a large number of traders previously bought at a certain level, they remember that level, they'll watch it again. Institutions reference these zones. Algorithms are built around them. When price comes back to that area, there's established interest waiting. The zones that carry the most weight are ones tested and held multiple times. Every time price returns to a zone and holds, more participants notice it. A zone tested 3 times is significantly more powerful than one tested once. Round numbers matter too. Bitcoin at $20,000, Ethereum at $1,000. These aren't random, they're psychological anchors. When enough people treat a number as significant, it becomes significant. That's just how human behavior works at scale. So, draw zones, not lines. Give them width, a range of a few percent. Price doesn't snap off a single exact number. It reacts within an area. If you're drawing razor-thin lines and getting stopped out on wicks, that's the problem. Alright, so here's exactly how this works in practice. The first thing you do is open the daily chart, not the 1 hour, not the 15-minute, daily. Identify your major support zones by looking at previous lows that held multiple times, old resistance levels that the price broke through and then returned to, and round numbers that the market has already shown it cares about. Draw them as zones with width, like I said earlier, then close the chart and wait. And I mean actually wait. Most of the job here is patience. You're not acting on every oversold RSI you see across every chart. You're waiting for price to come into one of your pre-identified zones. Specifically, when it does, that's when RSI becomes relevant. So price enters the support zone. Now check RSI on the same daily time frame. You're looking for it to be below 30, ideally below 25. That tells you selling isn't just elevated, it's genuinely stretched at this exact location. When both are met at the same time, price inside the zone and RSI below 30, you now have 2 independent signals agreeing. At that point, drop to the 4-hour chart and look for a clean entry candle, a strong close off the lows. A bullish engulfing, something that confirms buyers are actually showing up, not just price sitting at a level. That's the core of it. The RSI indicator tells you when, support tells you where. Together they answer the only question that matters. Is this a real reversal point or just another false signal? Let me walk you through the Bitcoin setup from late 2022 into 2023. Because this is one of the cleanest examples of this approach playing out in real life. Bitcoin's 2017 all-time high was around $20,000. That number burned into the memory of every crypto trader who lived through that era, the first peak that made mainstream news. When Bitcoin finally broke above it again in late 2020, it was sort of historic. That zone then carried double significance going forward, a previous all-time high and a confirmed major breakout level. So when the 2022 bear market hit, smart traders had that $16,000 to $20,000 range on their radar as a major historical support zone. Around this time, the RSI on the daily was deeply oversold, but this time at a location that had real historical weight behind it, which is at the 20,000 support zone. Bitcoin went from around $20,000 in January 2023 to over $30,000 by April 2023. The setup wasn't complicated, it was two things aligning at the same time. Traders watching only RSI had been buying since May 2022 and taking losses. Traders waiting for RSI to hit, oversold at a support zone that actually mattered, were positioned for the real move when it came. That's the difference. Now this is where most people drop the ball even after getting the entry right. They nail the setup, they're up 40%, and then they give all their profits back because they had no plan to get out the trade. The same framework works in reverse for exits. When price pushes into a resistance zone, check RSI on the daily. If it's above 70 and climbing towards 75 or higher, you've got location and timing aligning on the upside. When that happens, you start scaling out, not dumping everything at once. Take a portion of your profits at the first resistance zone, maybe 40 to 50%, and move your stop loss to break even on the rest. If momentum is still strong, let it run to the next resistance level. But once you have overbought RSI at a historically significant resistance zone, you reduce. In crypto especially, reversals can be sudden and violent. Having a planned exit removes the emotion from the decision at the exact moment when everyone else is getting greedy. Entry without an exit plan is just speculation. This framework literally gives you both sides. You know when to get in and when to get out. But what about when the trade goes against you from the start? Because that happens, and if you don't have a plan for it, one bad trade wipes out 3 good ones. Stop loss goes below the support zone, not at the bottom of it, below it. Specifically, 3 to 5% below the lower boundary of your zone. Price wicking into a zone and recovering is completely normal. That's the zone doing its job. A daily candle fully closing below your zone is different. That's the market telling you the thesis is broken. Buyers didn't show up, the level failed. You get out, no argument. Placing your stop below the zone, not as some arbitrary tight level, is what separates you from the traders who get stopped out on legitimate wicks and then watch the trade go to their target without them. Now before you enter any trade with this setup, run this check. What's my risk and what's my realistic target? The minimum you should be looking for is a 1-to-2 ratio. Risk 5%, target 10% minimum. If the nearest resistance zone is only 6% away and your stop is 5% below entry, that trade isn't worth taking. And position sizing, this is what nobody talks about, but it's what actually keeps you in the game. Never risk more than 1-to-2% of your total account on a single trade. That sounds conservative, it is, but it's also what's going to stop you from blowing up your accounts. Have you been using RSI completely alone this whole time? Or have you already been combining it with something? And if you have, what's been working and what hasn't? Drop it in the comments. That's it for this video. Subscribe if you want more videos like this. Trade smart.